Hello everybody, welcome back to my channel where we talk all things finance and investing. In today's video, I'm going to talk a little bit about interest rates and their impact on the stock market. There's probably no other factor that impacts stock prices in the stock market more than interest rates. They absolutely dominate and I expect they will continue to do so this year in 2025. So let's get into the video, how interest rates will impact stock prices. Okay, so there's really a few different ways that interest rates will impact stock prices. Some are pretty direct and some are a little bit more indirect, but I've kind of narrowed it down to three ways, or the top three ways that interest rates will move stock prices. Number one, interest rates have an impact on companies themselves. So what do I mean that interest rates can impact companies directly? Well, think about it. Companies need to borrow money to finance their projects in most cases. And if the cost of borrowing the money, which is really what interest rates are, if that goes up, then therefore the costs to the companies is going to increase, the cost of capital. Imagine a company is looking to build a new factory or a new plant somewhere, and they want to borrow some money to finance the project. Well, naturally, if interest rates have gone up, the cost of that has just gone up. And therefore, they have to rerun the numbers and make sure that it still makes sense for them economically to do so. So higher interest rates increase the cost of capital for a business. Now, some companies are more reliant on debt financing than others. So therefore, for example, smaller companies that make up the Russell 2000, they would have more exposure to interest rate moves because they rely more on debt to grow their business. Whereas the mega cap companies, the likes of Apple and Microsoft and whatnot, have massive amounts of cash. So they just don't need to borrow as much. So they're less impacted by interest rates in this way anyways. That's why it's not uncommon to see the Russell 2000, the index of small companies in the US, sell off more aggressively when the feeling is that the Federal Reserve is going to raise interest rates or not cut interest rates as much as maybe people thought, which seems to be happening at the moment. Another way that higher interest rates can affect companies, although it's a little bit more indirect, is just the impact on consumers. Of course, people like you or I, if we see our mortgages go up or interest on other loans, for example, go up, then we're likely to spend less money in shops and stores and consumer spending will go down. And of course, that will hit the sales figures for companies themselves. So it's more of an indirect way of interest rates hitting companies' balance sheets. Okay, so the number two way that higher interest rates impact the stock market and stock prices, a little bit more direct, and that is through valuations. This one's a little bit more complicated, but bear with me, I think it's worth understanding. Have you ever heard the saying, a bird in the hand is worth two in the bush? Well, that talks a little bit about the future value of an asset brought back in today's money. So what a lot of professional investors like fund managers will do, if they're thinking about investing in a company, they will actually try and project the cash flow of that business going out the next 5 or 10 years. And then they will take that cash flow over that next 5 or 10 year period and try and bring the value of that back to today's money in order to get an idea of the intrinsic value of the company and decide whether it's worth investing in that business or not. So how does the math work? Well, basically, you would take the money that you might expect in year one, simple example, $1 million. So let's say I'm thinking this company I invest in might deliver $1 million in cash flow next year. Well, what is that worth in today's money? Because $1 million in a year is not the same as $1 million today. Why? Well, if I had the $1 million in my pocket today, I could put it into a bond, for example, and get a return of, say, 5% risk-free. So therefore, I would expect the company I'm investing in to deliver at least 5%, if not more. So how do they do that? Well, they use the discounted cash flow model. So they'll take the $1 million for a year and they'll divide that over using a discount rate. Now, the basic for the discount rate comes typically from the 10-year Treasury real yield in the US, which right now is around 4.7%. Then they will add on an equity risk premium because investing into companies got more risk, say, than investing in a 10-year government bond at 4.7. So they're going to want some more on top of that. But let's just keep the numbers simple for a second. Let's assume they use a discount rate of 10%, which is the 10-year yield plus an equity risk premium, and they decide to discount it back. Well, $1 million in a year's time, discounted back to today using a 10% discount rate, is going to be around $909,000. So what the investor will do is go over the next 10 years, calculate those cash flows, discount it back to today's rate, and then sum up all of those numbers to get a final value, intrinsic value of the company. But let's say the discount rate was only 5%. So lower interest rates, lower equity risk premium, and we discounted at 5%. Well, $1 million in a year discounted back to today's money at a 5% discount rate is actually a lot more than that, around $952,000. So as you can see there, as the discount rate used goes up, the value of the money goes down. So when interest rates go up, and that is the basis of the discount rate, the 10-year yield typically. So as that interest rate goes up, portfolio managers are going to see less value in companies, particularly high growth companies with more earnings going further out in the future. And that tends to be tech stocks. So that's why you tend to see the NASDAQ sell off more when interest rates are likely to go up or be held steady. So it's the discount cash flow model that gets used for this. So it has a very direct impact on stock prices, interest rates in this way when used as a valuation tool. Okay, so a third way that interest rates can impact the stock market and stock prices, and this really comes down to investor behavior. Following on from point number 2 that I mentioned a minute ago, as interest rates go up, investors start to change their behavior a little bit. For example, right now the 10-year is up around 4.7%, but if that gets to 5%, what you're going to have are a lot of people who think, well, I can make a risk-free return of 5%. Why wouldn't I take some profits from the stock market that I've gained over the last couple of years of 20% plus returns and put it into a 10-year government bond, which is basically risk-free. I got no worries about it going down, and I will take a 5% return. I'll wait for things to shake out in the market a little bit, and then maybe I'll come back in the market in a few years. That 5% tends to be a lot more attractive. And of course, as the rate goes up, bonds become more attractive to investors. So it's typical for investors to move money out of the stock market and into bonds to capture that risk-free return. And therefore, when people sell their stocks to do so, it has an impact on stock prices. And as you can see, it can snowball a little bit. More people sell to shift into bonds, and therefore prices come down, leading to more people to sell to shift into bonds. And this is investor behavior that we see all the time. So as you can see, increase in interest rates can have an impact on the psychology of the market overall. And psychology and emotions, as I've seen over my 20 years in this business, seeing hundreds if not thousands of people manage their portfolios, psychology and emotions are probably the biggest part of it when they shouldn't really be. So bear that in mind and use that as a tip for yourself. So there you have it, 3 main ways that higher interest rates can impact stock prices. They impact companies and the cost of them doing the business. They impact valuations on stock prices because of the discounted cash flow model. The higher the base rate, the higher the discount rate, the lower the stock valuations, particularly for growth companies like technology. And of course, higher interest rates change investor behavior. They tend to prefer to invest in bonds and get a more secure, higher rate than take the risk in the equity market. We're certainly seeing a lot of this now. The most recent jobs report was very strong in the US, and typically that's a very bullish sign for the economy, but it's forcing the Federal Reserve to reconsider their interest rate projections for 2025. Some are now starting to think that they may not cut interest rates at all in 2025. And if that's the case, you can expect the stock market to reprice downwards. But don't worry, as I've said many times on this channel, a long-term investor should actually embrace a market sell-off. Put more of your cash to work as the market sells off. Don't worry about the scary headlines. Always think about the long term. Invest in a diversified portfolio like index funds, and over time you will accumulate a much bigger portfolio and hit your financial aspirations. I hope you liked the video. If you did, why not like the video? Leave me a comment down below, share it with a friend, and if you haven't done so already, subscribe to my channel. I would really appreciate it. Trying to grow out, produce more content like this. And as always on this channel, thank you so much for viewing, and I wish you all the best in your savings and investment journey.